Have you ever wondered what leverage is and how it can be both a powerful tool and a dangerous weapon in the market? Let's dive into this mystery together. Imagine you're playing a game where you can bet on whether a coin will land heads or tails. If you only have your own money to stake, even if someone offers you extra cash to double your bets, that might sound exciting until something goes wrong. Leverage in the markets is just like those extra coins. It lets you make bigger bets with less of your own money, but it also means you can lose more when things don't go your way. And here's the surprising part. Leverage isn't just used by experienced traders. It's available to anyone who wants to try their hand at market trading. But just like in our coin flip game, the more you use leverage, the riskier it gets. It's like reaching for a cookie jar with a broken finger, pretty tempting, but also quite painful when things go wrong. Understanding how leverage works is crucial because once you know its power and perils, you can make better decisions and avoid those painful moments. So, let's unravel this mystery together and see why leverage can be both your best friend and worst nightmare in the markets. Okay, so let's get into the nitty-gritty of leverage. Imagine you have $100, just $100. Now, here's where things start getting interesting. With leverage, your broker is willing to lend you more money on top of what you've got. This borrowed cash can be used to buy even more stuff in the market. Let's say you decide to use a 1-10 leverage ratio. This means that for every dollar you have, the broker will loan you 10 times more. So if you've got $100, suddenly you're working with an investment of $1,000. That's like getting 10 times what you initially put in. Here's how it would work. You buy a stock or place a trade for $1,000 using your original $100 and the borrowed $900. If the price goes up, you make a profit on that full $1,000. But if it goes down, your losses are amplified too. And here's the surprising part. Leverage is like playing with fire. It can be incredibly powerful, but can also burn you really fast. That's why understanding how leverage works is crucial before diving in. Okay, so now here's the surprising part. Leverage works both ways. When your investments go up, your gains are magnified. But when they go down, your losses are massive too. It's like having a double-edged sword. Let's think about it with an example. Imagine you have $100 and decide to use leverage to buy shares of company. With no leverage, buying one share might cost you that $100. But if you use 2x leverage, your initial investment of $100 effectively gets doubled by the broker. So now, it's like you have $200 to spend on one share. Now let's say that share price goes up by just 10%. With no leverage, a 10% increase only gains you $10, because 10% of $100 is $10. But with 2x leverage, the same 10% increase on your initial investment of $100 turns into a gain of $20. So your original $100 now becomes $120. And here's the part most people don't know. It works just as badly in reverse. If that share price goes down by 10%, you lose money, and this time it's with even more gusto. Without leverage, a 10% decrease on your $100 means you only lose $10. Just a tenth of what you started with. But with 2x leverage, the same 10% drop now cuts your $100 investment in half to just $50. So, if the share price falls by 20% without leverage, you lose 20% of your initial $100, which is just $20. But with 2x leverage, that same 20% drop means losing almost all your money, $90. That's a massive loss compared to the initial $50. All right, so we've seen how leverage works and how it can amplify gains. But what happens when the market doesn't go your way? Let's dive into a real-world example to see just how dangerous leverage can be. Imagine you have $100. With 1-10 leverage, that same $100 is now multiplied by 10, giving you $1,000 in buying power. Now, let's say the market tanks and your investment drops by just 1%. If you're using this kind of high leverage, what happens to your $1,000? Here's the surprising part. If the market falls by just 1%, you lose that entire $1,000. That's a whopping 99% loss compared to just losing your original $100 if you hadn't used leverage at all. It's like putting all of your money in one very risky bet. Think about it this way. Without leverage, if the market drops by 1%, you lose only $1 out of your initial $100. But with leverage, that same 1% drop turns into a catastrophic loss of almost everything you invested. And here's why so many people find leverage risky, because these losses can be so severe and happen so quickly. It's like pushing a heavy rock down a hill. Just a small push, or in our case, a market move, can cause the rock to roll all the way down. So, while leverage can seem like a magic wand for making big profits, it's also a double-edged sword that can cut you deeply if things don't go your way. And here's the surprising part. Leverage can be incredibly risky because it amplifies both gains and losses. Let's use a simple analogy to understand why. Imagine you're playing a game where you can bet on a roulette wheel, but with leverage. Normally, if you place a $10 bet, you win or lose that amount based on the outcome of one spin. But with leverage, every dollar you bet is magnified by some factor, say 10 times. So, let's say your initial investment is $100 and the leverage is 5x. When you place a trade with this leverage, you're essentially betting $500 on each transaction. Now, if the roulette wheel lands in a favorable spot for you, you might double your money. But what happens when it doesn't go your way? You stand to lose 5 times more than your initial stake. To put it another way, let's say the roulette wheel is against you and it goes 3 consecutive reds, which happen 18 out of 38 times. In a non-leveraged scenario, this would cost you $100. But with leverage, every spin multiplies your loss by 5. 3 red spins could end up costing you over $750. The danger here is that small market movements can quickly turn into financial disasters because the losses are magnified. It's like playing a game where you're betting it all on one spin of the roulette wheel, or maybe even multiple spins at once. So why does this matter? Because in real-world trading and investing, markets don't always move in your favor. In fact, they often move unpredictably. Leverage makes these unpredictable movements more dangerous because small market fluctuations can lead to big financial setbacks. Understanding leverage's risks is crucial for anyone serious about trading or investing. It's not just about the potential gains. It's also about protecting yourself from potentially devastating losses. So what does this mean for traders? Leverage can be incredibly powerful, but it's also a double-edged sword. Imagine you're playing with a really strong magnet. It attracts things strongly and quickly, but if you drop in the wrong place, it could pull something down with tremendous force. In trading, leverage works in much the same way. When used correctly, leverage allows traders to amplify their gains, like using that super strong magnet to pick up multiple small metal pieces at once. But misuse can lead to catastrophic losses, similar to accidentally pulling a heavy object onto yourself. That's why it's crucial for traders to understand and manage their risk carefully. And here's the surprising part. Even experienced traders make mistakes with leverage. They might overextend themselves or fail to account for sudden market movements. This is why it's essential to have a solid understanding of your risk tolerance, set clear limits, and always have a backup plan in place. Remember, leverage can be incredibly useful, but it requires you to wear your thinking cap and be prepared for the worst-case scenario. It's like driving a car with super turbo boost. Great when used properly, but terrifying if you don't pay attention to the speed limits and road conditions. As always in the markets, knowledge is power. Stay informed about the risks and benefits of leverage and never take it lightly. If you fully understand how leverage works, you're one step ahead of those who just dive in without much preparation.